Welcome to our lunch, which is a sellout every year. It's just an absolute pleasure to come here to the Hotel Pierre. Number one, they need the business. Number two, the REIT industry can use some lifting. But number three, this is part of the program that is known today for its extraordinary capabilities. It's known today as the largest real estate institute, real estate school, real estate functionary in the United States. It probably exceeds anything around the globe. But we can't speak about the globe, we can certainly speak about the United States. And so today it's called Schack. A lot of years ago, it was called the New York University Real Estate Institute, which I happened to found in 1967. So a few days have gone by since then.
Good fun, Larry.
And the important thing is that we are blessed to have terrific leadership, and that leadership is Sam Chandan, who is not only the dean of the school, but it's the same Sam Chandan who holds the Silverstein, Clara and Larry Silverstein Chair at the Schack Institute for Real Estate. So I just want to tell you, I'm thrilled to be here, thrilled to see you all here, thrilled to just listen to one of the fascinating discussions on the other side of the hall before coming in here. Delighted to sit next to Sam Zell. Of course, together we're solving the problems of the world. So you guys keep beating, we'll solve the problems. And all I want to say is thank you for everything. Sam, come on up, it's yours.
Thank you for that very, very kind introduction. It is my privilege to welcome everyone again on behalf of Larry, the founder of the Schack Institute, our faculty, our students, our alumni, to this very wonderful program. If you were not here this morning, you might have missed that this is one of our most successful years ever. I apologize to everyone who's in the overflow rooms that we were not able to accommodate here in the main lunchroom. We're having a spectacular year at the Schack Institute with a whole range of new programs, and very, very briefly, it really covers the gamut from new academic programs in areas such as prop tech, a concentration in data sciences and data analytics, a coding course that will ultimately be required of all of our students, and the strong belief that no matter what analyst or associate role that you're going into, knowing how to really use and make better decisions from data is absolutely critical to the positions that you'll take on, as well as entrepreneurship and technology. Outside of the classroom in the co- and extracurricular space, amongst our many long traditions, we'll celebrate our 52nd year for the Capital Markets Conference this fall. We will have our third annual Symposium of Women in Real Estate this October, and I'm delighted to say it was it was something very new for us to try just a couple of years ago when we introduced the conference alongside the 50th Annual Capital Markets Conference. This fall, if we hit our targets, it will be the largest event of its kind anywhere in the industry, and I'm really, really proud of everything that everyone has done to make that such an extraordinary success. It is the 50th anniversary of Stonewall, which is an important milestone for NYU given our proximity to the site of the Stonewall riots. And so we're kicking off, again, another new tradition this year and are hosting the first, or our inaugural Pride Roundtable for LGBTQ students and professionals in industry who can serve as mentors. And what I'd ask of everyone here today is that if you know of an LGBTQ student who might benefit from that kind of program, this is mission-driven for us. By virtue of our scale, as Larry described, we're the largest real estate program in the world. We can do lots of really amazing things for our students. Smaller programs may not have the same opportunity, and so our doors for this kind of program are open. Please let them know, whether they're a young working professional or a student, they're welcome to join us for this, and it's really about what we do and who we are and the role that we play in the industry. The last thing I'll mention on this front is that through the generosity of a really large number of donors, we've been able to establish a new diversity and inclusiveness scholarship fund, primarily supported by Jimmy Kuhn. And we are introducing a new program related to that that will include for another first in real estate academia, which is a scholarship specifically for someone who attended a historically Black college or university undergraduate. So again, if you know of someone for whom that program might be appealing or appropriate, we would really love for your help in getting the word out. I'd ask that you please make a point to stay. The closing session for today's conference is a really, really important one. I was talking to Bill Ferguson, Gemma Burgess, several others in the industry. 49 women were appointed to REIT boards in 2018, the largest number ever, and it's an important milestone. We wanted to take advantage of the opportunity to hear from some of those people about what's happening in the boardroom and the way that the boards of the major REITs are impacting decision-making in the C-suite. Understand, we have about 550 people attending the conference today. About 100 of them are our students. Not only will it be an incredibly informative session, it's important for everyone to take the opportunity to attend, whether it's our women's conference or programs like this one. Our students need to know that not only other women are behind them, but the entire industry is behind them. And so please, take the time. It's going to be a really fantastic session. We'd love to see you this afternoon. In closing, I have to offer again one special thanks to all the people that are involved in making this conference so successful. All of the speakers, Robin and Adam, who've worked tirelessly on this conference. The staff of the Schack Institute and the School of Professional Studies have been absolutely extraordinary. And our sponsors, the sponsorship dollars that we bring in this year, as in previous years, each and every one of those dollars goes to support merit and need-based financial aid programs that makes a Schack education possible for students who, because of their financial circumstances, might not otherwise be able to come to our institute. So I want to, again, just send a special thanks out there to John Mechanic and the team at Fried Frank for their lead sponsorship of today's conference, Jim Takelet and the team at American Tower for their silver sponsorship, RXR, Monmouth Real Estate, Ackman Ziff, and Ferguson Partners. Please join me in thanking all of them for their tremendous support of the program. With that, I am not the Sam that you came here to hear from, and so I will pass it right along. Thank you.
I am also not the Sam you came to hear from. I'm not a Sam at all. I'm Adam Emmerich from Wachtell Lipton. It's my pleasure to be here with all of you and to be here with Sam Zell. Sam needs really no introduction, and I don't want to take time away from having a dialogue with Sam and hearing from Sam to recite his accomplishments over a very long and illustrious career, not only in real estate investing, but in investing in a whole range of other activities as well. It's all reprinted in the brochure. Many of you have had the privilege of hearing from Sam before, so I won't go through the list of accomplishments both here or globally, which is an important part of what Sam has accomplished as an investor and manager and entrepreneur. We're going to talk about a bunch of stuff today. Hopefully it'll be extremely interesting. I'm pretty confident it will be. Why don't we just start off, Sam, with talking about the U.S. economy. You've suggested that after a period of uncertainty, there's a lot more clarity today in public policy and regulation. And how do you think that's impacting the U.S. economy today?
Well, I think that the U.S. economy has responded to the fact that being in business is no longer considered criminal. I think that's a big plus. I wish we had a little more stable leadership, which we don't. On the other hand, I'm not sure the rest of the world has much in the way of stable leadership anyway. I think that the United States economy is very much, our opinions are wrapped up in, what inning are we in? How long has this recovery been going on? Did the recovery begin January 09? or February or March of '09, in which case it's pretty long in the tooth. But for everybody in this room who's in the real estate business, they all know that there wasn't a recovery in '09, there wasn't a recovery in '10, there wasn't a recovery in '11, and we only began to see recovery in '12 and '13, and only in the last couple of years have we seen real activity in commercial real estate. What does that mean? That mean we're in the fifth inning? I think these are all questions that we don't know the answers to, but we got to be careful we don't make too, life conclusions without enough facts. The fact that the rest of the world seems to be slowing, I think is something we should be concerned about. The United States can never be an island in the world, and if Europe and Asia are slowing, we're going to feel that here. To the extent to which we feel it, frankly, will depend on the overall environment. I think the environment in the United States is pretty good right now. I think the current interest rate environment, particularly for hard asset industry like real estate, is very positive. And we're all going to, I think, benefit from the fact that right now or pretty soon we should have been facing debt coming due where the spread between the debt coming due and the new debt was going to be 300 or 400 basis points, and everybody was going to say, how are we going to be able to afford that? Now maybe it's only going to be 100 basis points, or maybe less. So I think the overall real estate market is, relatively speaking, benign, probably with a tilt towards supply. And I think in certain areas, I think supply is a real concern, particularly in areas of the country where there are no barriers to entry and there are no difficulty in adding supply. And the United States is a wonderful place. We have always created a lot more real estate development capability than we ever had demand. And I promise you, nothing has changed.
So we're not in the first inning, though, in any event,
I don't
right?
think we're in the first inning. I don't think we're in the ninth inning. And I think that if we weren't impacted by significant slowing around the world, we likely would be coming through this pretty well. But I think we're headed toward oversupply, particularly in non-barrier entry markets. I think we're, even here in New York, Larry Silverstein and I were having a conversation at lunch, and we were counting on our fingers how many square feet have been built, south of Midtown. And the number is, 20 million feet. Have we gotten 20 million feet of new tenants in New York? Or as these buildings get finished and occupied, is 6th and 3rd Avenue going to be, you could shoot a cannon? I don't know the answer to that, but I think it's something to be concerned about. Just like, in Chicago, in the CBD, we've seen a 25% supply increase in multifamily. And what you'd expect, you're seeing free rent, you're seeing all kinds of discounts, because access to capital is, at least currently, not a burden.
Well, you previously said, maybe a quarter ago, when it seemed that rates were rising, that wasn't entirely a bad thing, and it might have curtailed a little bit of that excess supply. Are rates going to rise now, or what can we take from the yo-yoing?
I guess I'd answer that question in two ways. One, I'm not sure they can afford to rise. If you take the U.S. debt and you apply a 5.25% rate to it, which was the average rate for 30 years, this country is broke. So that means interest rates can't go back to where they were. So there's almost like an artificial cap that's built into the system. But of course, the more you artificially inhibit rates, the more at risk I think the overall economic system is. And the higher probability that inflation will become a problem going forward.
Where does that leave? I mean, obviously here at a REIT conference, where does that leave REITs? Are they going to continue to be buoyant because rates are low and returns are high, or are they going to be impacted by that inflation?
I actually am pretty optimistic about the future of REITs. Mm-hmm. I think that REITs, like any asset class, are subject to ebbs and flows. In 1993, when I addressed the NAREIT conference in New Orleans, the entire REIT world was $7 billion. And the entire population of the REITs were the people who couldn't make a living in the private market. The world has changed very dramatically. And I remember predicting that this would be a $250 billion market in 10 years. And everybody thought I was nuts. And now we're at $1 trillion. And I think we have been a little slow recently, but we're returning. Yes, we traded at 20% below NAV for a year and a half. Mm-hmm. So what? That was an opportunity that we've seen just in the last 4 months. We've closed that gap, by 75%. So I think ultimately liquid real estate is what REITs are all about. And in the end, we will have ebbs and flows of capital availability that will very much affect the private market, but I think is much less likely to affect the public market, giving REITs a much longer run than maybe everybody expects.
We had a bit of a contraction during the financial crisis of the number of REITs. We're back up to 175 or so. How many of them deserve to be alive?
30. Was I being too subtle? I think
No.
I could talk slower. I mean, what good is a $250 million REIT? What good is a $900 million REIT? What good are companies that trade by appointments? What good is liquid real estate if you have no liquidity? So the reality is that the top 30 companies, whether it be American Tower or Equity Residential or Taubman or that's where liquid real estate exists. It doesn't exist in the other 150. So I think the only person who's really concerned about the number of REITs is NAREIT, because they collect dues.
You think NAREIT is working surreptitiously to prop up the 150 REITs?
Well, I certainly would never accuse NAREIT of doing that. But I think that NAREIT historically has been very open to increasing the number of REITs. And I don't see anything against it. It's a trade association. NAREIT has been extraordinarily effective. I mean, when you think about the 1986 Tax Reform Act, which devastated the commercial real estate market, what that really was all about was the fact that real estate had no presence in Washington. And Washington could therefore screw the industry without any concern or about reparations or responses. That no longer is the case. And to a large extent, the combination of NAREIT and the tax guys together have given real estate a real voice in Washington and protected our industry, which, frankly, as the tech industry has found out, everybody has to be represented in Washington because our life is Washington affected.
Other than NAREIT, any prediction a year from now, 5 years from now, do you think we'll be in the same place, or will we converge slowly, perhaps, towards a smaller number of bigger REITs?
America is all about aspiration. I assure you that every $200 million REIT thinks they're going to be a $900 million REIT. And every $900 million REIT expects to be a couple of billion or more. So we're not going to do anything to discourage people, and we're going to encourage them. And as a result, we're going to create, I mean, American Tower, I think, is the largest REIT in existence. Is that right?
Yeah.
What was American Tower 25 years ago?
At $1.5 billion market cap.
Fine. So it's now 48 billion or something like that? 85. 85, all right. Once you get over 25 billion, what the fuck's the difference, right? But the point is that if we set some kind of artificial limits or created a gating procedure where we didn't allow new REITs and new ideas to become part of our industry, we would suffer accordingly. So I think that we're always going to, in effect, create opportunities. Some of them are going to grow like American Tower did. Others are going to be, surplus.
One of the things that was talked about this morning was the FANGs and other tech tenants, and certainly they've made a big impact, including here in New York, and maybe they'll be part of the demand that takes up some of that huge amount of space that you referred to. We obviously had a sort of a different experience recently here in New York with one of the FANGs tried to come to town and didn't work out for a whole variety of reasons. Do you think whether it's a populism or a new school of antitrust or something like that is going to have a permanent impact that will impact ultimately the real estate industry?
Well, I don't think there's any question that tech is underregulated today, and I've never been a big sponsor or a big, adherent of regulation, but I think tech today represents just the opposite, where, you have a company like Facebook that goes from one scandal to the other because it can't control what is put on its platform. We have newspapers, we have TV stations, we have all kinds of entities that interface with the public. And in order for the privilege of interfacing with the public, they have to accept certain responsibility. These tech companies to date have effectively done all this without any responsibility. I think, we've seen the end of that. What impact it'll have on the real estate industry remains to be seen. We're still in a period of excessive liquidity. And with excessive liquidity, you can have a company like Lyft go public. It only lost $1 billion last year, so it was only up 21% on its IPO, which was at 40 times revenue or some preposterous calculation. Maybe I don't get it. I think that's perfectly reasonable. I'm an old man. But, I somehow or other, just like when I first, kind of got educated, I never understood how earnings was relevant as opposed to cash flow. Kind of nothing has changed. So, Lyft is losing $1 billion a year. Uber is losing $2 billion a year. Maybe the next IPO will lose $5 billion a year. And that's how we grow. That's not a formula that I would like to endorse.
So in terms of, credit tenants, you think these...
What's credit?
In terms of...
I bought something called Speaker Properties in 2000. And I had all kinds of tech tenants. And I took great comfort from the fact that these guys had $100 million in the bank, in cash. But they were losing $8 million a month. So, in effect, they didn't pay the rent.
Yeah.
So I think that ultimately we're going to see a change in environment where capital is not going to be so willing to allow losses because one of these companies might work.
You've talked about industrial as the flavor of the month, and I'm curious to know, is that a positive comment or a negative comment?
Well, as I've said often, I read a lot. And I think that historically I've made a lot of decisions based on collecting information without really, without understanding it, but then thinking about it and thinking about what I've been reading. And we're not in the industrial business except in Japan, which is a very unique market. But almost everywhere I go and everything I read talks about how much industrial is under construction. Industrial is not sophisticated real estate. Industrial construction is not the same as building a complicated, multifaceted office building. It seems to me that we're creating a lot of industrial, and I find it hard to believe that there's enough supply. Again, our development capability is much greater than our demand capability, and I think we're likely to see some softening in that arena.
And do you think there'll be a first inning at some point where it's ripe for harvesting at a deflated bubble price?
I can't answer that question.
Yeah.
I don't know. I think that we've had lots of experiences over the last 30 or 40 years where various forms of real estate have been inflated and people have cashed in and reality has set in later. It's very possible. I don't know.
Let's switch to a different category. We're here near Madison Avenue, very, very high-end retail. Vacancy in Manhattan is 20% compared to 7% as recently as 2016. Is it going to go to 50%? What's going to happen?
I think that to some extent it's going to be a question of rate. I mean, I think the trip from 7% to 27% is primarily attributed to the internet and e-tail. But the reality is during that period of time, storefront retail rates tripled. So the cost of entry for a retailer to play at the street level has dramatically changed. And so in effect, the real estate industry, by increasing its rates, have basically reduced the number of users or reduced demand. And I find it difficult to believe that people can afford to be in the retail space at the rates that are being charged.
So you think it's sort of a self-inflicted strategy
I
by the retail owner?
I don't want to understate the importance of e-tail and the importance of the internet on retail sales. But I think that, if you see a 2 or 3 times increase in the rents, you've got to assume that there's likely to be a decrease in demand.
Fair enough.
I mean, I went to college, I took Econ 101, I worked in the class, and on the board it said supply and demand. Amazing how it still works a couple hundred years later.
You've been a student of demographics as well over the years. We're here in the U.S. and one of the fewer Western developed economies that isn't suffering with an aging population. You think that will continue, and what impact will the difference between the way the U.S. is developing and other countries?
First of all, I think the U.S. is suffering from an aging population, maybe slower than Japan and slower than Europe, but the average age of our population, if the average age in Saudi Arabia is 25, the average age in the United States is 45, the average age in Japan is 55, and the average age in Slovakia is 50 or something. I think that ultimately demand is a function of population. And to the extent that our populations are thinning or the proportion of older people is changing the ratio between workers and old people, I think this is a very serious question for society overall. And how we respond to it and how we allocate capital to deal with it is going to be very much the story of the next 100 years. As population increase and aging increases at the same time.
So in terms of sectors in the U.S., what does that make more attractive? What does it make less attractive?
We're in the mobile home park business. Our mobile home park REIT, which was originally called MHC, which is ZELL'S today, is the single best performing REIT. We used to perform below you, we've now passed you. So, but it's the number one, it's the number one performing REIT since 1993, when it went public.
Yeah.
You could say, well, our demographic is older. We're catering to a growing part of society. The reality is nobody will give you a permit to build a mobile home park. So not in my backyard creates and maintains and limits supply. Therefore, you make a lot of money.
Yeah.
Unfortunately, those same constraints are not available or not existent in senior housing, as an example. Therefore, I don't know all the answers, but I wouldn't, and I haven't done the work, but I would guess that just like the airline industry has still not returned the amount of capital that was invested in the airline industry from the beginning, so too do I think that senior housing has as yet not returned capital, because you can still grow senior housing. You know, and everybody wants to have a senior housing living near them, but not a mobile home park. So therefore, you have a lot of senior housing. Therefore, it hasn't earned its rate of return. A lot of talk about, you know, catering to the older demographic. I don't think that, generally speaking, everybody has, or anybody has come up with a predictable formula for taking advantage of the change in the demographics.
What about the U.S. versus elsewhere in the world, whether it's on a demographic comparative basis or otherwise? Where are the hot spots that you're intrigued by these days?
Well, I mean, I think that the problem, you know, when you look at the whole world, is that, you know, you are attracted to those areas that are growing. So, you know, you get excited because Brazil is growing at 6 or 7% a year. It's 180 million people. So you scale. But, you know, we invested in Brazil in 2005, and the real was 167. Today, the Brazilian real is 404 or something. You know, you can be a genius as an investor, but if the currency is depreciating by that much, that's really dangerous. And that makes making a profit much more difficult. Also means that in the emerging markets, I think timing is much more relevant than it is in the United States. I mean, we've all made a fortune in the United States by owning forever. If you own forever in the emerging markets, you end up broke. So you basically need to be a lot more nimble in those markets, but recognizing that, I mean, we built you know, the world's largest affordable housing company in Mexico, and made a fortune. It was just an unbelievable story. And then they overbuilt it and overregulated it, and in effect, all of those companies that did so well all went broke together. So, you know, that's part of the risks in non-developed world, that they can, in effect, go extremes one way or the other and destroy the economic benefit or the economic basis of your investment.
So any specifics on where you're jumping to, where you're jumping out of, or where you would?
Well, I think that, first of all, when you get outside of the United States and Europe, it's not really where you jump to, it's where you get pushed to. And I think it's really important to understand the distinction between jumping and pushing. I think that, you know, I mean, it's like, you know, we talk about timing. I mean, you know, we've built a company in India that's in the limited service hotel business. And all of a sudden, you know, they're taking companies like that public in India. Well, you know, we may in effect get to take advantage of it, and it's going to work out. But you also could have a 10-year drought where where there is no access, you know, to the capital markets in places like India or China or Latin America. So I think, you know, you got to be nimble.
I suspect you probably followed the whole Flipkart saga in India, where regulations were introduced to limit the flexibility to do business after a foreign owner had come in. Did that surprise you?
It didn't, nor should it. But I mean, you know, Barry Sternlicht was interviewed this morning, and he talked about how terrific Berlin was. You remember?
Yes.
And if you read today's Wall Street Journal, there was an article about the city of Berlin is talking about expropriating all of the housing. Wait a minute. I mean, maybe Barry didn't read this morning, but I mean, you know, the answer is that. First of all, being hometown, whether it be in India or in Berlin, is nothing new. I mean, you know, I sat next to lunch with Larry Silverstein, and he talked about the fact that he bought the World Trade Center. Well, when the World Trade Center was put up for sale, Equity Office was the largest office company in the world. And they came to us and they said, you know, you're going to bid? And I said, no. And they said, no. And I said, you know, this is going to be hometown. This is going to be owned by somebody locally who is able and capable of navigating all of the vagaries of the local market. And Mr. Silverstein meets that test and has therefore been successful despite 9/11. But the point is that anybody who thinks that, you know, it's like I follow people who talk about, you know, well, we write the best contracts in the world. Yeah, when you're a lawyer, right? You know, you charge for it, right?
Guilty as charged.
You know, do you think that if you wrote the best contract in the world, I could enforce it in Brazil?
Maybe not even in Manhattan.
Yeah, hardly, right? Exactly. But for sure in Brazil, let alone in Ulaanbaatar or somewhere else. So, you know, you have to understand what it means to go outside of the rule of law. The rule of law is an extraordinarily positive thing that can give you great confidence as an investor. And it, by the way, in the reverse, where there is no rule of law, the rule of the jungle applies, and it's a whole different standard.
We were talking before lunch about geopolitical risk. Rule of the jungle reminds me of Venezuela, which you touched on. Is that I mean, not for investment purposes, but from geopolitical risk purposes in terms of the global situation, Venezuela's number one? What else is on your list in terms of risk?
As I said when we discussed this morning, you know, everybody, you know, we've all spent the last, whatever it is, 4 or 5 years reading about Syria, and the refugees are, you know, running over Europe and all this other. I think there's only been about 1,800,000 refugees coming out of Syria. There are already 3 million that have come out of Venezuela and are destabilizing Brazil and Colombia and Bolivia and Ecuador. I don't know what that means, other than that's really scary, because that could destabilize all of Latin America. I think that, you know, I mean, there are lots of other places where there are difficulties, and you see, you know, Putin is interfering in Venezuela. I think, or I hope that the U.S. response will be different than it was in Syria.
Change the subject totally to hopefully something that's not as scary, which is the rise of passive ownership in the REIT world, where it's actually, for a whole variety of reasons in terms of index membership, actually among the biggest in any sector. How do you think about that? Is it good for America? Is there a problem? Is it irrelevant in terms of how companies think about their mission and their investors?
I don't think that passive is positive. And I don't think that it is healthy that we're basically observing control of the real estate companies being shifted from the risk takers to the passive players. You know, in almost every battle that's gone on in the REIT industry, it's the passive players who are the fulcrum players, and yet that's you know, by history, that doesn't make any sense. I mean, if you're passive, then you in effect shouldn't respond, shouldn't take steps. But what you have now is you have the passive investors writing letters to the CEOs of all the companies, giving them, 4 pages of governance, expectations that are unconnected to being passive. So if you're passive, then you in effect say, I'm going to ride with whatever happens. But if I'm passive aggressive, that's what's really going on.
Right.
And I think that's very dangerous for our whole industry. And the fact that we are higher proportion of passive players is not a good thing. Not a good thing at all.
What do you think is motivating that aggressive side of the passive aggressive?
Hey, I think Cuban Goody said it all, follow the money. I mean, the reality is that, various forms of real estate vehicles have been created, of which there is a lot of demand for passive income, and therefore a lot of demand for passive vehicles that invest in real estate.
And in terms of those governance prescriptions, what's the reason that those passive fund complexes are in that business? Is there some underlying story that motivates them, or is it just a question of using?
It's probably hypocrisy. it is, from my perspective at all, they are, quote unquote, trying to be, good governors, which, by the way, I think is not a bad objective, but if you're acting as good governors, then you're not passive. So they really need to decide whether they're passive or active. And if they're active, that's fine. If they're passive, that's fine. But to be passive and then act doesn't make sense and creates disparities.
One of the things that, whether it's passive or other investors as well, actually are interested in these days is ESG. And I guess I'd ask you the question, do you think that's making the world a better place, companies more responsible corporate citizens, or do you think it's something that the market itself would work out anyway?
I've never, ever seen a situation where change has ever occurred where it wasn't economically beneficial. And I don't think anything has changed. And I think ESG is nice. I'm in favor of apple pie, and I'm in favor of, a lot of other positive things. But in the end, we're all motivated economically. And to the extent that we stay motivated economically, we will continue to attract capital. To the extent that we are no longer or mitigate our economic interests, we will, in effect, ultimately have more difficulty attracting capital.
Interesting. So you think that, will we see more regulation on the ESG side, or you think it's purely a private phenomenon?
I don't know the answer to that. It's, we have an environment right now where a lot of institutional investors are using their ownership as a way to pursue other goals. In the long run, I worry about that, because I worry about the fact that, or I take great comfort in the fact that economic goals create best decision making. And to the extent that we obfuscate that, I think we run a risk.
What about going private? You think that kind of public market, whether it's hypocrisy, aggressive, non-economic goals, is that going to lead to increased going private in the year and years ahead?
I don't know the answer to that. I think that there's been a lot of discussion recently about, why haven't, there been, public to private transactions. I think the answer is very simple, and that is that the economics do not dictate it. The spread is not that great. The risk, if you're taking something private at a 7% return, what is it you're expecting to happen on the other end that's going to make that good? So I think that there always will be private transactions, but but I think we probably, I mean, think about how different the commercial real estate world is today. When I first started, 99% of my competitors were other entrepreneurs who were at risk. And those were the people that I competed against. Today, if I were to do an analysis of this room, how many people are writing their own checks? How many people are investing in real estate with their own money? How many people are sitting here in one form or another representing other people and, in effect, taking and adjusting risk accordingly? And I think that that's one of the major changes that has occurred in our industry over the last 30 or 40 years as we've gone from a very almost jungle entrepreneurial environment to institutionally driven scenario. And there's, you know, I see very little on the horizon that is likely to change.
One of the things people have talked about for years apropos of that is, you know, the social issues and M&A and founder, CEO generation in the REIT universe and so forth. And as long as I've been involved in the industry, which certainly isn't as long as you have, you know, people say, well, that will change one day. And we haven't really seen it change. We haven't seen that wave of M&A. We touched on it a little bit before. We talked about the number of REITs and so forth. Do you think that there is more appetite for M&A in the current, more institutional environment?
Well, I don't think you phrased your question in the context of M&A. And I think the more broad question is the one you are raising, which is that, you know, we never had REITs until 1990. We had REITs back in the days, but it was, as I said, if you couldn't get a job in the private market, you went to the public market.
Yeah.
And then in 1990, the savings and loans went broke. Insurance companies went broke. Real estate was the R word as far as banks were concerned. And we had no choice but to access the public markets and begin the process of changing commercial real estate's base from private individuals taking risk to institutional investment and asset class allocation. And I don't see that reversing itself. So the days of whether it be the Taubmans or Mort Zuckerman or myself or other, quote, founders, I think you know, will be a nice footnote in history.
But not a catalyst for more M&A.
Or I don't think we're going to create a whole bunch of new, you know, founders.
Right, right. Well, and what about M&A more generally? Again, you know, this is everyone's here looking for prognostication.
I think everybody talks about M&A, but you don't create M&A unless there's disparity between the public and the private markets. If you believed the 20% spread that existed, you would have seen a lot more M&A activity. The fact that you didn't see it suggests that the conventional wisdom was that, if anything, real estate was overpriced, not underpriced. So therefore, you had very little M&A activity. To the extent that that continues, I think you're going to just continue to see a dearth of M&A activity. There's no justification for it. There's not enough economics there to encourage it.
And the big bounce we've seen in the last, you know, quarter is really a change in conventional wisdom?
I think it's just catching up. I mean, I watched the REITs trading at 20% of NAV, you know, 20% below NAV. So what? You know, it wasn't actionable. Okay, I couldn't buy any significant portion of any of those REITs that were trading at 20% discount. So, in other words, if XYZ company were trading at 20% discount and I made a tender at 15% discount, you'd laugh at me. What, are you kidding? Who's going to sell to you at that? And they're right.
Yeah.
So the reality is one needs to remember that a stock price reflects the supply and demand that exists in that stock at 359 that day, and is not indicative of much beyond what the supply-demand situation is at the closing of any given day.
Talk about something different for a second, which is REIT balance sheets. There's kind of a great homogeneity in what the market expects in terms of leverage. Obviously, for private market real estate players, including before the emergence of REITs, leverage was a very powerful force. Do you agree or disagree with conventional wisdom?
Well, I mean, I made a fortune by virtue of leverage. So for me to suggest that leverage is not the beverage is not necessarily relevant, okay? But the reality is that the public REIT market has asked for and demanded low leverage, that they are not interested in taking significant risk. And therefore, wherever the market is where the capital is available. And one needs not to forget that ultimately, real estate is all about access to capital. The creation of the modern REIT era was arguing that if you created the right formula, capital was always accessible. It was just the price thereof. So in March of '09, when David Simon sold equity and debt and showed that if he lowered the price, that there was always liquidity, that ultimately vindicated the whole, everything that we have tried to do since the beginning, which is to, in effect, treat real estate just like automotive or steel or any other heavy asset. It's only a question of price, as opposed to the old days where you'd have, quote, overnight, no availability of capital to real estate, period. And it wasn't a question of how much or what the price was or you're going to pay more. Or, it was just not available or not available. What the public markets have done is change that scenario and say it's only a question of price. And there's this famous story about Winston Churchill, who was sitting next to this woman, and he asked her if he could sleep with her for $1. And she says, "What do you think I am?" And he says, we know what you are. It's only a question of price. So in the same manner, that's what this is all about.
So is the public, if that's true in a sense, then you could be David Simon in '09. If he had been more leveraged beforehand, he could have also rescued the ship by selling equity. It might have been a more distressed sale.
Well, I think you're covering two different subjects. One is the availability of capital,
yeah,
and the other is a distressed situation.
Yeah.
The question is capital available to the commercial real estate market? And what I think David Simon proved in '09 was that it is always now available to big liquid companies, period. And that is an incredible achievement.
Let me change the subject again for a sec to you were involved in what's now EQC, coming in as a co-activist or rater and seized control of the thing, and you've sold off $3 billion of properties. And I take it it's not a vote of lack of confidence in the U.S. Real estate markets, but it's a particular strategy relating to those assets that were assembled into that company.
Well, wait a minute. I don't know anybody who buys markets, and I don't know anybody who sells markets. I think you buy individual assets and you sell individual assets. When we took over that company, I believe we had 145 assets, and we said, okay, which ones do we want to own? And when the number came out to be less than 10, it became relatively clear as to what we were going to have to do. And so we have been liquidating and piling up cash since. And at the moment, I think we've sold a great deal more than $3 billion, but we have $3 billion in cash on the balance sheet, and we're waiting for an opportunity. And we're pretty comfortable while we're waiting.
So reinflate, not in a bad way, but you'll make that into a vehicle in which you, to a new REIT, effectively.
Well, if we, are able to find the right opportunity to develop it accordingly, we will for sure do that.
That's great. Sam, it's been fabulous to be here together. Really appreciate the time.
My pleasure.
I think I can speak for the audience in saying we all appreciate it. So
Great.
thank you
My
so much.
pleasure.